You've probably seen the headlines, right? Some massive company makes billions of dollars in profit, but then you read they paid little to no income tax. It seems like some kind of financial magic trick. Well, I'm here to tell you it's not magic. It's a very sophisticated and, believe it or not, perfectly legal financial strategy. And today, we're going to pull back that curtain and show you exactly how it all works.
This right here is the central puzzle we're going to solve. You see this gap between the official government tax rate, what we call the statutory rate, and what a company actually pays, its effective tax rate? Well, that gap isn't an accident. It's the result of a very deliberate, rule-based system.
And here it is. This is the absolute core concept. Companies, legally and quite normally, maintain two separate sets of accounts. The first set, the book income, is for investors. It's meant to tell the story of the company's real economic performance. The second set, taxable income, is for the government, and it's calculated strictly according to tax law. They have different rules, and they have totally different goals. If you can get your head around this one idea, you've got the key to the entire puzzle. So let's break it down.
Here's our roadmap for today. We're going to start with the puzzle itself, then dive into the two key types of differences that cause it. We'll look at the tools accountants use to manage all this, understand the why behind the whole system, walk through a simple example, and then, most importantly, learn how to read a company's tax story for ourselves.
So how do these two sets of books actually diverge? Well, it turns out every single difference, no matter how complex, falls into one of two big categories: permanent or temporary. You can almost think of them as two different roads that any given transaction can travel down.
A permanent difference, that's like a fork in the road where the two paths never meet again. An item hits one set of books, but it will never, ever show up on the other. A temporary difference, on the other hand, is more like choosing between a winding scenic route and a direct highway. You both end up at the exact same destination, but the timing of your journey, when you get there, is completely different.
Okay, so let's put a slightly more formal definition on that. A permanent difference is an item of income or expense that shows up in one set of books, either for investors or for the government, but, and this is the most important word, it will never appear in the other. There's no reversal, no coming back. It's a permanent wedge driven between those two worlds.
And here are some classic examples of this. Let's say a company earns interest from a municipal bond. For investors, that's income, plain and simple. But for tax purposes, it's often tax-exempt. That directly lowers the company's effective tax rate. Now flip that around. If a company gets hit with a big government fine, that's definitely an expense on the financial statements. But the tax code almost never lets you deduct penalties, so that increases their effective tax rate. These permanent items are a huge reason for that gap we talked about at the start.
All right, now for that other road, temporary differences. And this is where things get really fascinating, because unlike those permanent items, this is all about timing. A temporary difference is an item that actually shows up in both sets of books, just in different years. It's created in one period, and it is absolutely guaranteed to reverse itself at some point in the future. Depreciation is the absolute perfect example. So, to encourage investment, a government might let a company write off the cost of a new machine really fast on its tax return. But for its investors, the company wants to show a steady profit, so it spreads that same cost out evenly over the machine's useful life. What happens? In year one, you get this huge tax deduction that lowers the tax bill. But down the road, the investor side expense is going to be bigger than the tax deduction, so the tax bill goes up. Over the whole life of the machine, the total depreciation is exactly the same. It's just the timing that's different.
So you might be wondering, if these differences are all just about timing, how on earth do accountants keep track of it all? Well, they have some special tools that live right on the balance sheet. They're called deferred tax assets and deferred tax liabilities.
The easiest way to think about it is like this. A deferred tax asset, or a DTA, is kind of like a prepaid tax coupon. It's a future tax break that you've sort of already paid for. A deferred tax liability, a DTL, is the exact opposite. It's a future tax bill. It's an IOU that you owe to the government that you know you'll have to pay eventually. So how do accountants actually figure these out? They use what's called the balance sheet approach, which sounds way more intimidating than it is. It's really just a logical process. First, they look at an asset's value on the investor books. Then, they figure out its value for tax purposes. That's called its tax base. And guess what? The difference between those two numbers is the temporary difference. You just multiply that gap by the tax rate, and bam, you've got your deferred tax asset or liability.
But let's just step back for a second. Why does all this complexity even exist? I mean, why not just have one set of rules and be done with it? Well, the answer really lies in a fundamental, almost philosophical conflict. This quote right here just nails it. The whole goal of financial accounting is to give investors a fair presentation of what's happening. But tax accounting, it's all about what the government wants to accomplish. Yeah, raising money, for sure, but also encouraging certain behaviors, like investing in new equipment, through tax breaks. They are just fundamentally different tools built for different jobs. Of course they're going to have different rules.
All right, theory is great, but let's put this all together and see how it actually works in the real world. We're going to walk through a really simple example of how a company gets from the profit number it shows investors all the way down to the income it reports to the IRS.
So, let's say our company A reports a cool $1 million in pre-tax income to its shareholders. That's our starting point.
First up, we have to adjust for those permanent items. Our company had a $50,000 expense for a government fine. Now, while that definitely reduced their book income, it's not deductible for tax purposes. So, for the government's calculation, we have to add that $50,000 right back. From the government's point of view, the company's income is now effectively $1,050,000.
Next, we adjust for the temporary or timing differences. Remember that depreciation example? The company took $100,000 more in depreciation on its tax return this year than it did on its books for investors. That's a legitimate deduction that lowers the income that gets taxed this year. So we subtract that out and we arrive at our final current taxable income of $950,000. That is the number that goes on the tax return.
But here is the absolutely crucial point that so many people miss. That $100,000 tax deduction didn't just make the tax disappear forever. It just kicked the can down the road. The company still has to record what's called a deferred tax expense of $21,000. That's the $100,000 difference times a 21% tax rate. That amount gets added to their DTL, their IOU to the government. So remember, temporary differences change when tax is paid, not if it's paid.
Okay, so why did we just go through all that? Because understanding this process is way more than just an academic exercise. It transforms the tax footnote in an annual report from this incredibly dense, boring compliance document into a powerful tool for real financial analysis.
And this is how we solve that mystery from the very beginning. In their financial reports, companies provide a chart that looks just like this. It's called an effective tax rate reconciliation. It literally walks you step by step from the official 21% rate to the rate they actually paid. And in our example, you can see exactly how that non-deductible fine pushed their real tax burden higher. So the real trick is knowing what to look for in that tax footnote. You see a big, growing deferred tax liability? That's a pretty clear signal that the company's cash tax payments are probably going to be going up in the future. See something called a valuation allowance against a deferred tax asset? Whoa, that's a potential red flag that the company isn't sure it's going to be profitable enough to even use its future tax breaks. But if they turn things around and reverse that allowance, it can create a massive one-time pop in their earnings. It's a whole story of risk and reward hidden right there in the tax details.
Look, at the end of the day, this isn't just about accounting rules. Grasping this concept of the two books gives you a much more sophisticated level of financial intelligence. You move past just reading the numbers on a page to truly interpreting the story that those numbers are trying to tell you about a company's past, its present, and its future.
So the next time you see a company's tax rate reported in the news, you'll know it's not just a number. It's the final chapter of a really complex story, one that's written in two different languages, the language of investors and the language of the tax code. And now you have the key to read them both. So, what story will you uncover?